So I don't have a strong view of what happens for the next 6 months because we do have a decelerating economic condition. And so that can put potential downward pressure on the longer end. But I do expect that there's more room for interest rate cuts than there is for the long end to really go a lot higher or a lot lower. And so to the extent that we get a steeper yield curve, maybe not over the next 6 months, but over the next 18 months or more, I think it'll be a combination of lower short end interest rates and then kind of flattish longer duration rates would be my base case. So that could be 50 basis points lower, could be a 50 or 100 basis points higher. Depends on what happens. Anything can happen in the next 18 months on that end. But I think that'll probably be combined with a somewhat lower on the short end of the curve in response to economic deceleration, as well as because by that point probably would have a new Fed chair along with the rest of the committee that sets policy would probably have a more dovish bent compared to what we see now. And as far as my bond outlook, to the extent that I want to have some duration, it's still generally in that 2 to 5 year range, less so in that very long term range. That way you can potentially, if you get a 2-year treasury, you can potentially participate in some of the cuts that could happen in the years ahead and lock in more of your yield. But I still think that the attractiveness of the long end of the curve is still not particularly high despite so much underperformance. And while it's suitable for a trade now and then, I still think that there are much better asset classes out there than the long end of the curve. And one of the things we've seen is that like when the Fed did mildly trim interest rates before pausing again, mortgage rates and other long duration parts of the curve didn't really go down with it. There's been a lot of recent political drama about how the Fed should be lower in terms of interest rates, and that argument might have some merit to it. But it's important to keep in mind that just because they lower interest rates, there's no guarantee that the long end would behave accordingly, and in some cases it might even go up. Because if the market perceives that the Fed is not serious about inflation or is too dovish, it could sell off the long end of the curve, including mortgages. And so, to the extent that I, in many ways, interested in fixed income, I'm more interested in the short end of the curve. Well, one of the things I do is that I have a separate slice for energy producers. To the extent that I'm in the energy sector, I've been preferring to play it primarily through the equities, through the producers, because oil has been very range bound. So I've been preferring to buy the assets that are trading at pretty low multiples, that are profitable at current oil prices, that in many cases are paying dividends or buying back shares and have good balance sheets at current oil prices. And basically what that does, that kind of serves as perpetual option on Middle East destabilization or anything else that might drive energy prices higher. And in the meantime, it pays me to own it. And so right now we're generally seeing that at current oil prices, US shale is kind of gradually stagnating. So there's not a lot of drilling activity. It's not really encouraging a lot of new investment. And of course, there's pretty fast depletion rates in US shale. And so we have this kind of stagnant situation in the US, still kind of tepid demand growth globally, especially with the Fed as tight as they are and other factors and tariffs and things like that. So a lot of uncertainty. As we kind of look forward a couple years, I generally think that, with US shale oil no longer really growing at the pace that the market's become accustomed to, and as we potentially get those Fed cuts, maybe next year, for example, I do think we could see higher energy prices. But then in the meantime, any sort of flare up that is hard to predict in advance, I still like to own it in advance of that. And so in addition to my broader equities portfolio, I have that separate slice of energy so that I basically have some protection, at least against unexpected crises without trying to overthink it too much. So my concern right now, for the next 2 months, I think we're in a vulnerable window where, like you said, we don't have all the information. There's a lot of uncertainty over the next couple months. And even the recent deals are still pretty high tariff rates compared to, pre-April. And so back in April, there were all these tariff proposals and the market freaked out. So equities sold off, credit markets freaked out, basically higher spreads. And right now, estimated forward tariff rates are pretty similar to what they were back in April before the de-escalation. And yet the market is at all-time highs, credit spreads are narrow, there's really little concern. And so my general view is that there's more risk from tariffs than is probably being priced in. And so short of a major reversal, I do think that it'll be an ongoing friction against the U.S. economy and then particularly tariff-heavy sectors. Most analysis so far, like when you look at import prices, they're not down and they're measured pre-tariff. And so there's not much sign that foreign exporters are absorbing the cost, which means most of the tariff revenue is coming from some combination of American consumers and American businesses. There's also the fact that because tariffs were telegraphed in advance, many importers front ran the tariff. So they pulled in extra imports in quarter one. And that gave them some degree of a buffer against, as, kind of the US Treasury takes in, I think they reported over 150 billion in tariff revenue. Well, they also, because the importers pulled in a lot of products ahead of time, that gave them some buffer before they have to really kind of pass on costs to consumers. If the tariffs do stay in place as they are, I do think that'll increasingly trickle out to consumer prices. And so most of this is at least a mild drag on the US economy that somewhat offsets other things that are stimulating. So we're still running pretty large structural fiscal deficits. Nothing stops this train. That's still the background situation. But then that is, at least around the margins, somewhat offset by these structurally higher tariffs. And most of the deals we see, like we saw the one with Japan where, we place tariffs on them. Certain sectors are, more targeted than others. There's generally headlines around, say, big investments that Japan's going to do. But when you dig into the details, mostly it's lending, which in many cases they're already doing. That's generally how this mechanism works. The US runs these really big trade deficits with the rest of the world. They take the dollars and then they often buy our assets or, deploy their credit into our assets. And so I expect that to continue. But basically, I think that we have this new kind of annualized multi-$100 billion tax that is roughly spread between American consumers and American businesses. Obviously, some sectors are more impacted than others. So we see, for example, Ford talking about the tariffs, but we don't really see Microsoft worried about the tariffs. And the reason that's notable is when you look at, say, the way these companies kind of operate is Microsoft is something like 100 times the market cap of Ford. So when we're talking about investing, we're talking about the stock market, it's all about Microsoft. It's not about Ford. But when we look at the broader economy or socio-political situation, Microsoft doesn't even employ twice as many people as Ford does, despite being 100 times the market cap. And so things that slow them down or impair them, while they might not be as spectacular in the near term on the stock market, they do tend to trickle out quarter by quarter as we see some degree of stagnant economic conditions. So I am currently in the camp that views gradually decelerating U.S. economic situation. We don't have great seasonality coming up, especially by September in the stock market. So I do think that at least this 2-month window is a time for, potential caution until we have, maybe a little bit more clarity on what tariffs are going to look like going forward. I kind of have two different pools of capital that I manage. There's the macro side and there's the venture side. So EgoDeath Capital, we just raised $100 million for Fund 2, which deploys in the venture space. So we lead Series A investment rounds, and our focus is on the Bitcoin space. So there's been kind of billions of dollars raised for the broader crypto ecosystem, whereas what we focus on is primarily Bitcoin, to some extent stable coins, and basically things that focus on kind of high utility. And so we still perceive a big market for that. That's why we're doing the private side. And then on the public side, my strategy continues to focus on the 3-pillar portfolio. So one pillar is high quality equities, both US and globally. Another pillar is hard monies, so Bitcoin, precious metals, and you can put commodity producers in that bucket. And then a smaller slice of cash equivalents to protect against volatility and to rebalance into any turbulence that can occur along the way. So one of my focuses lately is that I think we're seeing a wake up in Latin American equities to some extent. It's never going to be a straight line, but I think we might be past the turning point of them kind of perpetually underperforming US equities in aggregate. I've also been fairly bullish on Chinese equities, but then in the United States, I'm more focused on both growth and value stocks, but ones that tend to focus a little bit more on the service sector. They're generally more protected from tariffs. They're generally more protected from the cyclicality of the economy. And I do think we are at a little bit of a deceleration currently. But whether you look at growth at a reasonable price stocks, including some of the Mag 7, or you look at some of the more value type of equities. So I'm pretty bullish on the financials in the US economy. I think they're relatively well protected from some of the downside scenarios, but they're still inexpensive, unlike some of the highest quality tech stocks that are out there. And so I think there's still a lot of opportunity in equity markets, even though I do think that the top line of the index is kind of stretched at the current time. For the broader side of the portfolio, I think that while I'm still bullish on gold longer term, starting about 3-4 months ago, I got concerned around a consolidation potential. We've been in that consolidation. I think it probably still has room to go. But once we do get to a breakout, I would resume my bullishness on that. And I still continue to be focused on, perhaps not surprisingly, Bitcoin in that hard monies bucket, because while gold is a mature $20 trillion asset, Bitcoin I still think is rapidly growing growing into the asset that it's going to become. And so as it has exceeded $2 trillion and as it continues to grow and build its network effect and reach corporate and to some degree sovereign adoption, I continue to prioritize that in the portfolio. And cash equivalents, mainly just that's because I'm not bullish on long duration bonds still. I'm not as bearish on them as I was, say, 4 or 5 years ago. But basically, as we, now we're kind of in a period where you get a lot of volatility in them, still not very high yields. And so I use some cash equivalents as a buffer, but it's not an area that I tend to be prioritizing because the overall backdrop of what I focus on is that because we're in fiscal dominance, things tend to run hotter than a lot of the bears expect. So I've generally been fading some of the arguments to be heavily in cash, even though I don't like to be zero in cash and cash equivalents.